Where are property markets going to be in 3 years' time? That's what a lot of people are wondering, considering we're going through a bit of a rough patch in residential real estate in Australia at the moment. So today I'm going to give you my thoughts, and I'm also going to share the thoughts of a report from BIS Oxford, who have given their 3-year forecasts, and I'm going to have 3 property experts help me as well. So welcome to this week's episode of the Michael Yardney podcast.
Are you interested in property investing, success or money? Well, you're in the right place. This is the Michael Yardney podcast, where each week you'll learn a number of new ideas regarding success, property investment and money in 20 minutes or less. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, who has once again been voted Australia's leading property investment advisor. That's the 4th time he's won a similar award in the last 6 years.
It's impossible to escape the cold hard fact that the Australian property market's undergoing some major changes. Thanks to APRA's macro-prudential measures that have restricted lending, particularly to investors, and more recently, the Banking Royal Commission's findings making the banks more allergic to risk, the availability of credit has tightened. In other words, investors in particular are having difficulty getting finance, and all this has led to our property markets moving to the next phase of the property cycle. We're in a phase of slumping prices in some locations and slower property price growth in others. And these changes have been great fodder for many of the clickbait headlines in the media, which have brought out the property pessimists again saying, "I told you so." But don't panic. The markets are behaving normally. So today I'm going to share with you some thoughts on where I think the property markets are going to be in 3 years' time. And I'm going to be joined by 3 experts as we unpack the BIS Oxford report. But first, I want to remind you that periods of strong capital growth, like we experienced in many of our capital cities over the last couple of years, are always followed by periods of flat growth, or sometimes no growth, or falling property prices. That's just how markets work, especially after phases of unsustainable strong growth, as we experienced in Melbourne and Sydney in particular over the last 4 or 5 years. But this time round, our property markets have peaked in a low interest rate environment, so we're not going to experience strong mortgage defaults, and businesses are still going to be able to borrow to create more jobs, to create more inventory, to grow. And this means we're in for a soft landing as supportive fundamentals such as our strong economy, jobs growth, population growth are going to underpin our property markets. Now, having personally invested through 6 property cycles, I've learned to appreciate the opportunities that this stage of the cycle presents. But I also recognise in times such as we're heading, many potential home buyers and property investors, they're going to sit on the sidelines waiting to be told that the market has bottomed. Of course, this type of market actually creates opportunities for people who've got a long-term outlook. And that's partly why we're going to be talking about what's ahead over the next 3 years rather than what's ahead tomorrow. Look, I also know that some investors who step into the markets today are going to lose out because they're going to make mistakes, but then those mistakes are not going to be covered by a rising market like they were a couple of years ago. In other words, correct asset selection will be more important than ever, and property investors are going to need to be more strategic and think long term. But back to the question I initially asked, where are property markets going to be in 3 years' time? Because that's a question a lot of people are asking as we've moved to this slower growth phase of the cycle. Now, one group of forecasts, those by BIS Oxford Economics, used to be called BIS Shrapnel, suggest we're in for a soft landing. Their recently released Residential Property Prospects 2018 to 21 report, which predicts the property market outlook, has been getting a lot of press. So I thought I'd share some of their conclusions with you and also give you some of my thoughts and the thoughts of 3 other property experts that we're going to be having a chat with in a short while. Now, of course, we know the main purpose of property predictions, don't we? It's to make meteorologists look respectable. Currently, there's no shortage of experts trying to predict where the property markets are going to head. Then there are all those online research reports telling you where you can invest in the next hotspot. As I said, meteorologists tend to predict weather better than property commentators predict future capital growth. Now, this doesn't mean you shouldn't listen to the experts. You should, but you must also understand the level of accuracy of their predictions and take that into account when you're doing your personal investing. Now, before I share the report from BIS with you, I actually checked back on their track record. They're brave enough to give 3-year forecasts and put them in public. There's no other organisation in Australia that I know who do that. And they're also brave enough to put their track record on their website so that you can see what's going on. And I'm going to give you a link to that in the show notes. So go to michaelyardneypodcast.com and have a look at the show notes. Anyway, sometimes BIS shrapnel overestimated property price growth, and in other years they underestimated. They were a bit too pessimistic. But as I said, at least they put their predictions out. Very few forecasters go further than 3 months, 5 months a year. So what's ahead? Look, I've already said it, house price growth's been slowing, but that's been particularly led by Melbourne and Sydney, our two big property markets, our two most expensive property markets, and prices there are falling gently. And the trend looks like it's going to continue further throughout this year because APRA's tightening regulations, even though they're not tightening them anymore, are still biting, and the Royal Commission has made the banks a bit more nervous about lending. They're being a bit more careful. And at the same time, we've got a period of weaker wages growth, which makes it a bit harder for many people to afford to pay more for properties. And in some parts of Australia, we've got an oversupply of apartments. So these tighter lending conditions, the inability of investors to get more money, it's much the same as having a higher interest rate, and they've slowed down our markets, particularly the Sydney and Melbourne property markets, which were the ones in particular led by investors, and I think the same is going to happen for Hobart real soon. But again, the markets aren't going to crash. We're in for a soft landing, but there will be further price falls in some markets in the short term, and I'm going to go through state by state what's going on in a moment. And most likely, if you take inflation into account, there's probably going to be modest declines in all capital cities. Well, that's what BIS Oxford predicted over the next 12 months. So over the next 12 months, flat falling prices, and then they predicted that all capital cities are going to turn around and show price growth over the next 3 years. But that price growth is going to be fragmented. Brisbane's going to be the winner with around 13% price growth over the 3-year period. And I'm going to go through state by state in a moment what BIS Oxford believes is going to happen. I'll give you my thoughts as well. Well, you knew I would, didn't you? So BIS suggests the current slowdown is due to what I just said, tighter lending conditions, but also the fact that we've been building too much. There's over 200,000 new apartments being built a year around Australia, and that's led to an oversupply in some states. Personally, our research at Metropole shows there's an oversupply of inner city, CBD apartments already in Brisbane, Perth and Canberra, and to a much lesser extent in Melbourne. But as I said again, the good news is our property markets aren't going to crash because we've got a low interest rate environment. This is a long, long time since I've gone through a downturn in a low interest rate environment. This is really a credit squeeze. And we've got a relatively stable but subdued economic environment, and we've got strong population growth. So there should be upside in every capital city between now and 2021, according to BIS Oxford. And that's going to be underpinned, they say, by high net overseas migration inflows and economic conditions increasing and us slowly using up that oversupply. It's actually population growth that's going to absorb that oversupply. So let's go through state by state what they think is going to happen. And let's start with the Sydney property market. And currently the Sydney median house price is, well, it depends who you read, but $1.12 million. And it's forecast by BIS Oxford to go up 3% between now and 2021 to 1.150. The downturn in Sydney, according to BIS Oxford, is expected to continue and probably continue on until next year, and then prices are slowly going to rise. The harbour city has, of course, seen huge prices growth, prices have soared 85% since 2013, with investors, and remember, investors accounted for about half of all mortgages during that period, with investors pushing up property values to record highs. But in face of retreating investor demand, the report forecasts that first home buyers are now going to get back into the Sydney property market to support particularly apartment prices. So BIS predicts Sydney's median price is going to fall by 2% in the next financial year, in this current financial year, 2018-19. But the undersupply of dwellings in Sydney are going to prevent large price falls. In other words, the old supply and demand ratio is going to come back. And they, as I said, believe the property price growth is going to go up by about 3%. But that's overall in Sydney. Clearly some areas are going to do better than others. So to understand what's going on the ground in the Sydney property market, I want to have a quick chat with Ahmed Imam, Director of Metropole Properties in Sydney. Hi, Ahmed.
Hi, Michael. Pleasure to be here.
Now, BIS Oxford suggests that the Sydney property market overall isn't going to do as well as it did the last 3-4 years, but we knew that was coming. You can't have growth that's at an unsustainable rate. So what are you finding and your team finding on the ground in the Sydney market at present?
Yeah, I think that's fair, Michael. And I think the last 5 years of growth was certainly unsustainable. We've seen the market soften. We've seen changes in finance with very tight lending conditions. We've seen changes, of course, then in property. The market has softened. The market has slowed. As you say, Michael, we've probably gone from maybe fifth gear to first or second gear. But in this session, I really wanted to put things into perspective. We've seen 85% growth in Sydney in the last 5 years. So market sentiment has no doubt changed, but where you buy in Sydney is going to be crucial to what kind of growth you see going forward.
So, Ahmed, what do you see the main growth drivers of property over the next 3 years in Sydney?
In my opinion, the main growth drivers are going to be centred around population growth, around infrastructure growth, the employment market and jobs growth, and also the transport system.
Well, Sydney's clearly the economic hub of Australia and one of the two big super cities, Melbourne and Sydney. So it's punching above its weight in economic growth, in jobs growth, and also in migration.
Yeah, absolutely. I mean, we're now at 5.1 million in terms of population. We are a global city. We're growing by 1.7% per year, or approximately 7,000 people per year. Michael, 8 of the 10 most densely populated areas in Australia are actually located in Sydney. And the top 5 are located around the CBD, which is why we talk so much about being around that population growth and understanding where that growth is occurring, because there's no doubt it is occurring around the inner middle rings of the CBD.
Now, that's interesting because people who don't live in Sydney probably won't understand that to live in Sydney nowadays, you've almost certainly got to live in an apartment or medium density dwelling. And that's very different to if you lived in other parts of Australia or regional Australia. We've become a world city in Sydney, but there's a lot of infrastructure spending on the books to help Sydney's economy grow.
There is. We've got about $80 billion worth of infrastructure spend that's happening currently. Many projects. Infrastructure alone is not enough to be a good driver of growth, Michael, as you very well know. But if you've got the other fundamentals there that I've discussed, then yes, infrastructure is important. We've got Sydney Metro, we've got the Southeast Light Rail, we've got the West Connects. We've even noticed that suburbs along, the under construction Sydney Metro have outperformed the surrounding suburbs over the past few years, just due to that substantial investment, which is probably around a $12 billion mark. So infrastructure is a great driver, but important to note that you have to have those other key fundamentals there as well.
Things like wages growth and jobs growth, because in fact, affordability is going to be the constraint in Sydney, but it's not unaffordable for everybody. It's unaffordable for people with poor wages or in blue-collar jobs, but people in high-paying jobs still can afford to. And I think we're finding on the ground at the moment, they're still buying well-located properties, Ahmed.
They are. People in high-paying jobs are still buying in areas that are affordable to them. as you mentioned. And so they're still situating themselves in affluent pockets like the eastern suburbs, like the lower North Shore, like the inner west, some suburbs within the St. George area. And what's interesting, Michael, is there is a lot of talk about Sydney's market softening, and there's no doubt it has softened. I'm not going to sit here and say that it hasn't, but it's softened as a whole on average. We have to keep in mind that Sydney has 658 suburbs. We actually only buy in 24 suburbs. That's how selective we are. Sydney's got 40 local government areas. We only buy in 4 of those local government areas. And the reason is we still want to focus on the right demographics and the right location. And to give you an example, Michael, the auction clearance rates have no doubt reduced and they've dropped. The last 5 years, when we've saw a large growth phase, on average, the auction clearance rates were well above 70% consistently. On average across Sydney, they probably dropped down to about 50%, which shows that there's much less demand. However, in those pockets that I mentioned, those 4 main local government areas and then specific pockets within them, the auction clearance rates are still well above 70%, which shows that Sydney is and always will be very fragmented in terms of its performance and growth.
So looking forward, what's going to make a good investment property in Sydney?
There are certain pockets that work and there are certain pockets that don't work. Okay, so all those things that I mentioned, like population growth and infrastructure, transport system is another one that's important. Look out for those key fundamentals, but you want to stick to areas that have shown and proven themselves. So areas that have shown and proven themselves for decades and show that historical growth and trend, and they tend to be the suburbs in the inner middle rings of Sydney. Further to that, look at the demographics. So look at where the affluence is. You look at where people have good jobs with good wages and disposable income, because the people that are paying a premium are the ones that are bringing the prices and growth within that area up. Again, they tend to be the inner middle rings. So if I'm being specific, we certainly focus on the blue chip pockets of Sydney, Michael, like the eastern suburbs, like the lower North Shore. But what is really interesting is, as of late, the most desirable pocket in Sydney, due to its great value, has actually been the inner west. It's been an underdog for such a long time, and it's been overshadowed by the eastern suburbs and the lower North Shore. But the inner west shares the culture, the cultural amenities, the transport systems of the eastern suburbs, but at a much lower price point. So it's been a very, very interesting pocket and something that we've been buying quite a lot in.
Great. Well, I look forward to continuing having these chats with you and see what transpires in the Sydney property market. Thanks a lot, Ahmed Imam from Metropole Property Strategists in Sydney.
Thanks, Michael. My pleasure.
Okay, let's move on to BIS Oxford's forecast for the Melbourne property market. And in June this year, the Melbourne median price was $870,000, and they believe it's going to grow 6% in the next 3 years to $920,000. Now, Victorian house prices surged 65% in the last 5 years, and that was underpinned by record population growth, and that fueled demand for housing, and that created an undersupply of properties in Melbourne. All those apartments that were built and that many predicted were going to create an oversupply, including me, were soaked up by all these new residents. Melbourne's growing at about 2.4% per annum, faster than almost any other developed city. And that means that our population is increasing by about 10% in the next 4 years. And that's one of the reasons why the Melbourne property market is going to perform well. But to get a better understanding of what's going on in the Melbourne property market, I now want to have a chat with Kate Forbes, National Director of Property Strategy at Metropole. Hi, Kate.
Hi, Michael. Pleasure to be here.
So what are you and your team seeing on the ground in the Melbourne property market at present?
If you look at the headlines out there, there's a lot of doom and gloom painting a really poor picture, and there's some very depressed sentiment out there. But as is always the case, there's no such thing as the market. It's very specific to certain suburbs and certain pockets, and it's uneven what we are seeing across the board. It's your inner to middle ring suburbs, your pockets of greater demand, quieter streets, slightly more affluent and cafe-lined suburbs with green leafy trees that are still seeing demand. When we go to auction for clients, we're still having to compete against other bidders. It's just less bidders than has been the case in years gone by.
So in the context of today's discussion about the next 3 years ahead, what do you see being the driving forces of the Melbourne property market?
As always, it's really important to drill down into the fundamentals of what is driving the market. And there hasn't really been a significant shift in those fundamentals. What we have seen, though, is a significant shift in credit extension. So how that's actually playing out is whilst we have unchecked demand, we just don't have the ability to get into the market that we've had in the years, and that's weighing on the market to an extent.
Well, that's in line with our research that we're going to have a quiet time in Melbourne for probably another 12 months, and then the fundamentals of supply, demand, population growth, jobs growth, ability to buy properties is going to outnumber the number of properties around, and so therefore the market is going to start moving again. So as an investor, what do you see the best opportunities in Melbourne over the next years?
Michael, our strategies don't change because the market changes. Being long-term strategies, they're necessarily designed to transcend the noise of market fluctuations. What made sense last year to invest in is largely going to make sense for you to invest in this year and in subsequent years. So that translates into your investment grade properties that are in your inner to middle ring suburbs. And as I mentioned earlier, your quiet leafy back streets, your properties that appeal to owner occupiers. And as we see that population growth continuing to feed through, those are the properties that will continue to grow even whilst the broader market is being rather flat or potentially going negative.
Well, with population growth of about 2.5% per annum, and that's unlikely to change over the next couple of years, if we give that a 3-year horizon, our population is going to grow 7-8%. Where are we going to put 7-8% more cars on the road, and where are we going to put all those people?
Well, unfortunately, a number of those people will necessarily be flung into the outer lying suburbs, but that's going to make commuting for them a little bit of a nightmare, which again places an emphasis on those properties that are that much closer in a 20-minute commute, less each direction, and those properties will command a premium and continue to command a premium over the ones that are further away from the employment hubs. I think it's Victoria who has the dubious distinction of having the fastest rate of growth in vehicle registrations in the country.
Well, that's interesting. Thanks for your input, Kate.
It's a pleasure.
Let's move to the Sunshine State and see what BIS Oxford has to say about the Brisbane property market. And in June this year, the median house price in Brisbane, according to this report, was $550,000, and they thought Brisbane was going to be the best performing market over the next 3 years, growing 13%, with the median price jumping to $620,000. They see the oversupply of apartments, though, dragging down Brisbane's wider housing market. So if you take houses out of that 13%, they're going to perform even better. The Sunshine State's starting to see a boost of interstate migrants, particularly coming from Sydney, and there's lots of green shoots coming forward for Brisbane. So to get a better understanding of what's happening in the Brisbane market and what's ahead, let's have a quick chat with Brett Warren, Director of Metropole Properties in Brisbane. Hi, Brett.
Hi, Michael. How are you going?
I'm great. Now, Brett, I bet you're in a good mood too, because everything we're reading at the moment is suggesting that Brisbane is going to be the best performing property market over the next 3 years. Some people would say it's time.
Yeah, look, there's been a lot of the it's time factor in the last probably 5 to 7 years, but finally there's actually some driving force behind it, with immigration and jobs being created. And I think that's what the leading economists and experts are picking up on.
So what are those driving forces?
Yeah, it's like everything, Michael. It's jobs growth, it's opportunity. There's a wealth of jobs being created, and it's really going to be in and around the Brisbane CBD, where there's a huge expansion of the CBD happening, and also the Brisbane airport, where there's a second runway happening at the moment. And they're all due out for release about the same time, which is early 2020-21. So there's a lot of jobs being created building up to that, and then after that point, there'll be a huge amount of jobs being created as well.
Now, we're talking about Brisbane and not Queensland in general, is that right?
Yeah, that's right. As we've talked about before, there's a lot of seasonal jobs up that way in the north of our state with the mining and all those types of things. So the markets are very volatile. It's very hit and miss, where future jobs, full-time jobs are being created, and that's where people are moving, why people are finally coming to Brisbane again.
So people are coming for the jobs. It's an interesting trend, and it's not because prices are cheaper or because the weather's nicer, and in fact both of those are true, but the fundamentals of people having the ability to be able to afford to pay more because they're getting better jobs is one of the big drivers. So what's going to be the right sort of investment that's going to outperform over the next 3 years, Brett?
Well, like everything, Michael, the first thing that is important for everyone is probably job security. So that expansion is happening quite close to the CBD, so I probably wouldn't want to be buying any further out than that 10 or 12 kilometre ring, because there's not enough public transport and infrastructure to get people in and out of the CBD and the airports and hospitals. I'd also want to look for areas with good school catchments, good green space, walkability is another buzzword, and convenience that I think is very, very important. And all those types of things tend to happen within that 10 to 12K ring.
And apartments or houses?
Probably definitely houses at this stage. There's still a rebalance to happening with the apartment market, and that is definitely underway. Some experts are tipping there'll be some growth in the short term, but I think there's probably another 6 or 12 months at least of rebalancing. But houses are definitely going to perform strongly, and that's what the leading experts are noticing as well.
So buying houses gives you the ability to add value through renovations or refurbishment, and that's a great way of manufacturing extra capital growth, isn't it, Brett?
Definitely, yeah. We're definitely seeing that trend, and it's working well for our clients, especially if they're buying close to land value and they can add that value through renovations. A number of post-war homes in Brisbane are actually being bought for good amounts and just being knocked over and completely rebuilt. So that's areas we're targeting like that with gentrification is very important as well.
Sure. Well, that's one of the things. You're wanting areas that are improving and gentrifying, and the price point makes it very attractive. It'll be interesting to look back in a couple of years and see how these predictions have come to fruition. Thanks for spending a couple of minutes with me, Brett.
Thanks, Michael. I look forward to it.
One of the markets predicted to perform best by BIS Oxford is the Canberra property market, where in June this year the median price was $700,000, and they believe the median price is going to increase by 10% over the next 3 years to $770,000. Canberra's housing market has proven to be a quiet achiever in recent years, and that's going to continue on. House prices are forecast to increase by about 5% in the next financial year before slowing down over the following 2 years, but still a 10% capital growth over the next 3 years, or the predicted one, is pretty respectable. Of course, there's still a oversupply of apartments in Canberra, so they're not going to go up as much, probably only about 6% in the next 3 years. And Canberra's rental market's very tight, recording a 0.7% vacancy rate earlier this year. Part of that reason is I know many investors are avoiding Canberra because of the very high land tax, and I can understand why they're avoiding Canberra. Okay, there's some good news out west, according to the report, with the Perth property market finally having some green shoots and looking like it's going to do better. In June this year, the median price in Perth was $520,000, and it is forecast that in 3 years' time, the price is going to go up about 10%. Now, we know the Perth market's slumped for 4 years now, and the Perth prices have declined 13% since 2014. But according to BIS Oxford, the worst could be over, and they believe house prices are bottoming out. Of course, the vacancy rate in Perth is very high, over 5%, and rents have collapsed, falling by about 30% in the last 4 or 5 years. So, what's ahead for Perth? The report predicts the recovery for Perth is going to be a long, slow grind as the city works through its significant oversupply, and it expects to get minimal growth for the next couple of years, but sees stronger growth in 2021. Now, I agree with that. I've found in other markets where there's been a long, slow downturn like Perth has had, it's gone on for a long time. It's going to take a long, long time for people to feel confident. And when people actually see that the market has bottoming out. All those people who wanted to sell, the discretionary sellers, are going to start putting their properties on the market. So there's going to be more stock, and that's going to hold back prices. Too early, in my mind, for a counter-cyclical investment in Perth. What about Hobart? Now, we know Hobart's been the strongest property performer for a while. So BIS Oxford said that the median house price in June this year in Hobart was $485, and they forecast an 8% growth to $525,000 in the next 3 years. The report suggests that Hobart's affordability has been attracting expats and younger families and families with children, and they're suggesting that house prices are going to still increase by about 5% this year and then slow. In my mind, there are not many long-term growth drivers in Hobart, and we've seen it before. This year's hotspot becomes next year's not spot. I think it's a bit late if you're an investor to buy in Hobart. In fact, I would never have anyway. But if you're looking to move there, it's a great area to live. It's got a lovely lifestyle, and clearly it's very affordable. What about Adelaide? Well, BIS Oxford suggests that Adelaide prices are going to do reasonably well. They're going to grow about 9% over the next 3 years. Median prices in June this year were $510, and they think they're going to go up to $555,000 in 3 years' time. What the report said was, with South Australia's automotive manufacturing industry shutting down, its economy and its property markets remain subdued. Well, we know that's true. And they also say that a soft economic environment and lacklustre population growth is only going to lead to modest house price growth in the coming years. BIS predicts that Adelaide's shipbuilding industry will drive future employment and slowly boost interstate migration, lifting median prices up. So they have got some good news for Adelaide. House prices expected to grow by 9% by 2021. In my mind, though, I'd be in the big smoke if you can afford it. Darwin. Well, Darwin's had a rough time, hasn't it? It's peaked in 2014, and since then, house prices have nosedived 19%. But the report's authors said they expected them to have now bottomed out and starting to pick up. So if you own property in Darwin, that's good news. I wouldn't be looking to buy investment properties in Darwin, but the general oversupply means that forecasts are suggesting flat times ahead over the coming financial year, and then limited growth, maybe 5% growth over the next 3 years altogether. Now, that's the capital cities. Now, before you get excited and write in or email me and say, Michael, you haven't discussed the regional areas, I'm reporting what BIS Oxford said in their report. They didn't discuss the regional cities. I'll give you my thoughts now. 80% of our economic growth, 80% of our population growth is occurring in the capital cities. And in the capital cities, it's where wages are going up more. So yes, I know some people say invest in regional areas because we're going to be the food bowl of Asia, and I really hope we are. Invest in regional areas because that's where tourism is going to be boosted, and I really hope it is, because we need the overseas dollars to boost our economy. In both those industries, they're not high wages industries, and there's a lot of seasonal and part-time and casual work. What pushes property prices up is people's ability to afford more property and their desire to live in certain locations. So while there are no doubt that there's very desirable locations in regional Australia, if you like that lifestyle, it's just the fact that people living there aren't going to have the sort of jobs that are going to keep pushing property values up. So why fight the trends? Why try to fight it when there's a snowball happening in Melbourne, Sydney, and to a lesser extent Brisbane, of significant population growth, significant capital growth, significant property demand? So in summary, there are signs of softer growth conditions around Australia's property markets over the coming months. And it's time now to plan ahead. Don't be scared. This stage of the cycle is normal. Over the long term, the property market moves up in our big locations, in our big capital cities, and the market is behaving normally. And it's difficult during these times unless you've lived through them before. Interestingly, a couple of days ago, I was having breakfast with my ex-business partner, Gavin Taylor, who retired to live off his property portfolio a couple of years ago. And he said, "How are things?" And I explained to him about the downturn in the market. And he said, "Yeah, but we've lived through 6 of those, haven't we, Michael?" Because he's been my business partner, was my business partner for a long, long time. And yes, it's so much easier when you've lived through it before. I remember reading that King Solomon had inscribed in his ring, "This too shall pass." This made him more humble during the peak times and the exciting times and the booms, and it made him more comfortable during the difficult times like we're now experiencing in our property markets. So thank you for listening to this week's show. I hope you got some guidance for what's ahead. But if you want somebody to sit down with and talk about and understand how your property portfolio is working, or where you should be allocating your assets to invest, why not have a chat with the independent team at Metropole, my team? We've done a lot of research. We've got access to this research. We've got our own 20-year history, a research of what's going on in median prices in every capital city and regional Australia, and within that, what's happened in the inner, middle, outer ring suburb. So our thoughts are not based on what we guess or suspect or speculate. It really has to do with strategic advice based on deep down research. So why not have a chat with the team at Metropole? Go to metropole.com.au or ring 1300 Metropole, and we'd love to have a chat with you. And I'm looking forward to having a chat with you again this time next week.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from listening to this podcast, please leave us a review and we'll read it out on a future show. Just go to michaelyardneypodcast.com/review and it will take you over to iTunes, where you can enter a review and let us know what you think. We'd really appreciate it. If you don't already subscribe on iTunes or on your Android phone, you'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes or a transcript of the show, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success and money in around 20 minutes.